Headlines were swirling last week with Andreesen Horowitz sinking its largest single investment ever, $350 million, into Adam Neumann's next venture, Flow. With so much controversy around the spectacular implosion of WeWork and SoftBank's massive loss while Adam cashed out as a billionaire, the easy story to report is that he's conned investors again, because there sure as hell isn't a lot to report about what Flow actually is. But given that it's a residential Proptech startup, the Proptech Scout is on it. There's a trail of clues that we can follow to figure out what Flow might actually be. Now, going back to late 2020, Adam Neumann invested $30 million into Alfred, a software-based residential property management and concierge platform. Greystar invested in the same round, and they all ran a little experiment together in an apartment complex in Norwalk, Connecticut. There were apparently a lot of lessons learned by all parties, and Alfred expanded and refined their software platform from there. But Neumann is their single largest shareholder, and at first I thought this was a synergistic opportunity to nurture his investment and utilize the platform on Flow's portfolio. He was maneuvering to take a controlling stake in Alfred until a March 2022 funding round of $125 million explicitly blocked him out of gaining control. So instead, Neumann is likely taking all the insider info and lessons learned from Alfred to apply the ideas to Flow. And he's since distanced himself from Alfred and poached a couple of board members and consultants, leading us to last week when Neumann and Andreesen Horowitz publicly announced Flow. So what is Flow? Some outlets are saying it's a direct competitor to Alfred. That may be true, but I think Neumann had far greater ambitions. Andreesen Horowitz founding partner Marc Andreesen wrote a post defending the investment and provided some vague hints at what Flow is attempting to do. Andreesen bifurcated the residential experience into owning versus renting, claiming that there's more buy-in to a community when people own. But as a co-living developer, I have to disagree with how black and white his characterization is. Layer the sudden shift to remote work, and there's a need to create a community to fill in the social void of endless screen time. There's several hints throughout Andreesen's post explaining what Flow is. And I quote, "Only through a seismic shift in the way industry relationships are structured and the mechanisms through which value is delivered can we hope to address the underlying problems of the current system and build the solution. Doing this requires combining community-driven, experience-centric service with the latest technology in a way that has never been done before to create a system where renters receive the benefits of owners. This means rethinking the entire value chain, from the way buildings are purchased and owned, to the way residents interact with their buildings, to the way value is distributed among stakeholders. And given the fragmented nature of the ecosystem today, we can only hope to accomplish any of this by bringing every aspect of the living experience together." So what Andreesen is suggesting is that there needs to be a third option besides rent versus own, where people have the flexibility to move based on their work, but not miss out on the benefits of ownership. Let's start by thinking through what the benefits of home ownership are, and then we can work backwards from there. So first, you own real property, you have more financial security, you make paper gains when the property appreciates, and then you get a tax shelter from depreciation, and you don't have to deal with a landlord, and you can rent it out if you're not living there. Now with that in mind, how can a rental be structured with these benefits built in, assuming you can restructure everything about real estate transactions? Given Adam's shady salesmanship, this sounds like a timeshare in new clothes to me. My assumption, and I'm going to go with this for the remainder of the video, is that renters will purchase fractional ownership in a portfolio of apartments, starting with an initial down payment, and monthly payments thereafter will allow them to accrue more and more equity over time. So a typical payment may be structured sort of like a mortgage payment, but instead of principal and interest, it may be principal and rent. The more of the principal you've paid off, the less rent you're actually paying into the system. Now, the big benefit of owning a portion of this portfolio that they're really going to try to push is that members will probably be able to flow freely between apartments within the portfolio, as well as freely trade shares if they want to get out. Additionally, there will be community features layered on top of the portfolio to encourage renters to mingle together, much like what Adam did with WeWork. But let's step back a second. Why is Andreesen Horowitz even giving Adam Neumann another chance? Despite all the negativity in the headlines questioning how such a notorious and disgraced founder could raise such ridiculous sums again, it's important to keep two things in mind. One, controversy sells news. And two, repeat founders get funded way more often than first-time founders. Here's Marc Andreesen's defense of Adam Neumann, and I quote, "It's often underappreciated that only one person has fundamentally redesigned the office experience and led a paradigm-changing global company in the process, Adam Neumann." We understand how difficult it is to build something like this, and we love seeing repeat founders build on past successes by growing from lessons learned. Translation: like it or not, Adam Neumann created huge changes in the office sector, and it was incredibly difficult to pull off. So difficult that he failed. He also failed at getting WeLive, the We company's co-living brand, off the ground. And failure is a rite of passage in Silicon Valley. But lessons learned goes both ways. Someone doesn't just get handed $350 million without strings attached. The operational missteps at WeWork were very public, and I'm sure there were some safeguards built into the investment to prevent profligate spending. Marc will be on the board, babysitting Adam. Furthermore, this deal includes equity ownership in Adam's portfolio of over 4,000 residential apartments across Miami, Atlanta, Nashville, and Fort Lauderdale, to name a few. So as renters buy into Flow, both Adam and Andreesen Horowitz will cash out of their portion of ownership of these apartments at a higher valuation. It's a REIT that they're selling shares of to renters. And lastly, Adam's experience with Alfred and WeWork will allow him to execute on the plan quickly. He's setting up extremely tall operational moats faster than any first-time founder ever could. Arguably, the only other competitors that can execute on this model right now will be large private equity shops like Blackstone or institutional landlords like Avalon. But they're not techie enough to dress it up the way Adam can. Now, let's discuss how Adam Neumann can make money, and he's gonna make a lot of it. In the WeWork pre-IPO disclosures, it was revealed that Adam was doing a lot of self-dealing, buying up office properties and renting them back to WeWork so that he could personally cash flow. There's a slightly different structure here because investors were already burned that way. Adam likely got a fantastic basis on his apartment portfolio pre-pandemic. And now by packaging it up as a massive REIT and timeshare in disguise as a Proptech company, he's gonna have access to stupidly cheap debt. And he sold off a chunk of the equity to Flow, and therefore Andreesen Horowitz at a profit already. And since Andreesen Horowitz just started Flow off at a $1 billion plus valuation, he's likely already made quite a bit of paper gains. Other investors may be more skeptical this time around, but I wouldn't bet against him on growing it to a multi-billion-dollar valuation and cashing out at some point. Now, how is Andreesen Horowitz going to make money? There's two ways. First, which is a little bit strange for a VC, they're technically being a traditional REIT investor here. It's unclear whether all the $350 million went straight to Flow, or if a portion is backed by Adam's apartment portfolio, but once renters start buying shares, Andreesen Horowitz's investment can't go to zero, unlike other VC investments. And the second way is on the VC side, Andreesen Horowitz is counting on this model having a large enough competitive moat and an experienced founder to pull off WeWork-like growth without WeWork-like mistakes. It's a long road to IPO, but they can likely cash out during secondary offerings. And finally, how is Flow going to make money? Being a landlord myself and having underwritten dozens of institutional deals, there's so many ways for Flow to make money. They can sell off shares of the REIT at a profit, which we discussed. Then they can charge 1 to 3% on every transaction of selling those shares. They can collect rent, because not all the units will be explicitly owned. And since they are building a community aspect, that rent is going to be at a premium, just like they did with WeWork. They can also charge 2% asset management fees, 3 to 5% property management fees, and then a monthly community fee in the form of common charges, which is very typical for condo owners. And also, I don't think Adam will be the only landlord contributing his buildings to Flow. I think they have a much larger platform in mind for landlords everywhere to either exit by direct sale to Flow, or a slow exit by contributing their buildings and then selling off the shares to the members gradually. If the financials are structured in a way where the landlords who are contributing their properties have a nicer exit than in the free market, then the platform could probably scale pretty quickly. So when you nickel and dime a real estate asset with so many fees, the cash-on-cash return on the investment shoots up by multiples. So it looks like a fantastic investment for Adam and Andreesen Horowitz on paper. It's not quite a zero-sum game, but the members do have to pay for these fees somehow. And the value prop to them is that they're going to be sacrificing returns on their ownership, or they're going to be paying a premium for the rent portion of their payments in exchange for the benefits, which is basically mobility and ownership. And the mobility is really what I'm assuming is the origin of the name Flow. But I wouldn't be surprised if there's a hidden meaning that Adam is getting ridiculous cash flows from this too. Alright, let me know in the comments. Do you think I'm totally off base? Do you think this really is a timeshare and new clothes? Do you think Adam deserved another chance? Do you think he's really a competitor to Alfred? I guess we'll find out eventually. Till then, Proptech Scout out.